Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the low time frame bullish scenario where we're looking for an expanding diagonal 5-wave structure to the upside, where the most common target for wave 5 is between the 1 and the 1.618, taken from the low to the high of 3 to the low of 4, which is between 29.1k and 30.8k. Wave 2 over here retraced to the 0.5, less common for a wave 2 in an expanding diagonal, and wave 4 retraced to the 0.786, which is a common target for wave 4, so that's all right. The invalidation is if price would move to the downside and take this low at 26.5k. Now, in general, what is important to know is that expanding structures in Elliott waves are the rarest patterns, which always gives a little bit like lower probabilities to scenarios like this. Now, in this scenario, if we are looking for a wave 5 to the upside, we want to see bullish structures over here. So if we then zoom in and we go to the 30-minute, then what we're looking for here is a double 1-2 for then continuation to the upside. So you see 1-2, 1-2, looking then for wave 3 in blue to eventually finish. Now in this scenario, the blue count is the higher degree Elliott wave count. 1 and 2 in blue, 3 blue, 4 blue, 5 in blue. But inside wave 3 in blue, we are looking for the white count. 1, 2, 3, 4, and eventually a white 5. In this double 1-2, what you can see is that this second wave 1 of a lower degree is longer in price compared to the first wave 1 over here, which is a higher degree wave 1. And also this wave 2 in a lower degree, the Y2, is about the same length in time as the higher degree wave 2, which is not actually what you want to see and lowers the probabilities of this scenario. And that's also why this push to the upside still doesn't make me feel that comfortable, because most commonly what you see in a double or triple 1-2 is wave 1, 2, 1, 2, 1, 2, and then a push, where the second wave 1 is shorter in usually time and price compared to the first wave 1, but it does take the high of the first wave 1, and then the second wave 2 over here is shorter in time and price compared to the higher degree wave 2. But in this scenario, this second wave 1 here is higher, it's longer in price than the first wave 1, which is not really what you want to see, and the second wave 2 is quite long in time as well, which does not really give too high probabilities to this particular scenario. But what's happening more locally is actually more important, because over here we're then looking for the higher of 3, 4, and 5. Now, if you're bullish, you really want to see price making another high. Reason being that now the volume is in the high, which is typical for wave 3. But then you want to see a range in the wave 4 and another high to be made on lower volume, because then you have a wave 5 on lower volume, which gives more confidence for the bullish scenario. Currently, price bouncing on the 0.236 for potential wave 4. The 382 and the 05 are also targets, but the problem with the 382 and the 05 is that they are like a little bit in the middle of nowhere. They're in the middle of this inefficiency that we have over here, and that is not great. So if price would move to the downside, probabilities are very high that we find no support at the 382 and the 05, but instead go to the downside, reach this range again. But that's also the invalidation of a wave 4. So if price would do this, probabilities are high, of course, it's going to be invalidated, and that the bullish scenario is not in play. If I show you more information about this gap, it is actually very important. And I want to go to the 5-minute. So what you see over here is you see this push to the upside, and preferably if we think about bullish scenarios in, let's say, a double 1-2, 1-2 and a wave 3, I prefer wave 3s to have a solid structure, right? Like solid waves towards the upside, a nice push. But what we saw over here on the 1-minute, you see this type of stuff, right? This is not really what I prefer. A 1-minute very big candle. It's not really nice and structured towards the upside. Now, if you then zoom into the 5-minute and have a look at this big push, then what is important is the gap here, which is also called an inefficiency, fair value gap, whatever you like to call it. But important is that you don't want to see price getting acceptance in this gap. Having support once, so the moment the low over here of this candle is hit, it can act as support, which it has done. Price moving a little bit to the upside. However, the moment you come back down again and you again start to close candles over here, probabilities increase by a lot for price to move to the downside and fill this whole inefficiency. So that's definitely something you want to keep in mind. And if we go to the 1-minute, because we also have the 1-minute gap over here, then on the 1 minute, what you can see is that we did not yet reach this low over here, so it can still act as a little bit of support, 27.6k, but then again, only a first bounce. The moment you come back, it's not looking great. So the 5 minute, if you take this low, probabilities already increased to move down, then you have a little bit of a 1 minute support, but the moment this breaks, well, you know, more downside is basically expected. If we then zoom out once again and go to the bearish scenario over here, then we are looking at this move towards the upside from a bearish perspective, either an ABC, which is already finished, and you're looking for downside, where the invalidation is the high, 28.6k, meaning we are looking for bearish structures over here. Or the WXY, which is a flat in WX and then a zigzag in wave Y, where the target is between the 1 and the 1.236, which is between 29.1 and 29.8k. Also surrounding nice resistance areas over here. The blue box, 29.1, 29.4, and the higher one, 29.7, 29.8. So that's quite nice for then a move towards the downside. So that's something to pay attention to, that even if we move to the upside, we have to keep in mind this scenario is still in play. Now, if we then zoom in to the structures over here, then a scenario on the chart could be again an expanding diagonal, which I don't really like at the moment, this type of price action, but it is the way it is, because the thing is with this price action here, if we're looking bearish, then a normal impulsive structure is not possible because wave 1 and 4 are not allowed to overlap, which clearly here is the case. If we then look at a contracting diagonal, then this wave 3 is not allowed to be longer than wave 1, but it is longer. As you can see, it crossed a 1-to-1. So that leaves us with an expanding diagonal over here, or the alternative is that this is an ABC in a wave 1. This is your wave 2, and now you go down and then eventually a diagonal structure. So it's a zigzag 1, 2, and then you look for a zigzag, zigzag, zigzag. So you get a bigger diagonal, but that at the moment is way too early to call. So in this scenario, we then have a 1, 2, 3, 4, 5, 2 retracing to the golden pocket. That's common. Over here, wave 4 retracing to the 786, which is also common for a wave 4 and an expanding diagonal. But more importantly here is that you can see the golden pocket here is now acting as support. From the below to the upside, it's resistance. We crossed it and now it can act as support. So for the bears, it's of course very important to close candles below the golden pocket, which also means closing them inside the inefficiency, high probability of moving to the downside in this particular scenario. Of course, again, expanding structures are not common in Elliott waves. Another thing that I just think about actually is that over here we now have a double top. So you can see a 28k, actually high number 1, high number 2, high number 3. So you actually have a triple top there, which is quite interesting in case price does find a move towards the upside. Now the bearish scenario more locally can then be a zigzag as explained. So you then have a 3-wave structure to the upside, where it has to be said that wave C is very extended, and then an ABC towards the upside. However, as long as this high is not taken, an ABC is definitely on the cards. Look at this peak of volume over here in the high. For the bulls, as explained, you want a 4 and a 5. The moment you enter this gap, very high probability this is a C. You're going to move towards the downside. And another thing is that, of course, in a 5-wave bullish structure, you want to see impulsive continuation and not ranging for too long. The longer you're going to range over here, the more bearish it becomes. So you definitely want price to eventually move towards the upside. I also explained in the morning video that the value area high is an area of resistance, which over here has been tested. So price moving towards the upside, hitting the value area high. Brilliant, right? Like very nice, acting as resistance, and then for here very locally also creating bearish CVD divergences. Now first of all, we have the bullish one here and the bearish one here, so that's quite neutral. The bullish one appeared first, usually has a bit of a higher probability, but more local CVD is by far most important. And if we then zoom in, after hitting the value area high over here, which let me get it back on the chart, you can see after hitting that value area high, price moved down, retraced. And what you then see is bearish CVD divergences appearing first. Lower, high on price, higher high on the CVD, bearish CVD divergence. There's absorption of market longs going on, push to the downside. More bearish CVD divergences, again a push towards the downside. So those bearish CVD divergences are building up in this area. They have already played out, and the bullish CVD over here was invalidated. Now if we look at the AGGR chart over here for the divergences, then you can also see over here lower high on price, higher high on the CVD, and then over here lower highs on price but on yellow higher highs on the CVD. And this is in real time after hitting the value area high. This is over here what you then can pay attention to. On the 3-minute chart, you want to pay attention to those CVD divergences to increase the probabilities of certain scenarios, like over here, the ABC as explained. It should make you think, right? It's going to tick again, bearish CVD divergences on the AGGR chart, which is just something to keep in mind. Now at the moment, if we look at price over here, then we did have some bearish CVD divergences with this candle, so lower high on price, higher high on yellow. Preferably though, you're going to see CVD divergences on the right side over here of this most recent low. So let's see what happens there. But of course, that is not ideal that you have bearish CVD between this candle and the lower highs over here. If we then finally look at the probabilities, then the probabilities are a little bit different than usual because they're actually not necessarily Elliott Wave related per se, but instead the gap is very, very important. If you if price can take this high, probabilities are going to become significantly higher that we move to 29.2k. Not only taking this high with a swing failure pattern, of course, but start to close candles up here and having a solid move up. But the moment you're going to get acceptance in the gaps over here on, let's say, the 5-minute, but also the 1-minute, probabilities are going to increase for price to move towards the downside instead. And the reason why in this particular scenario I didn't really go into Elliott Wave probabilities is because we are constantly working with expanding diagonals, which is something that is never really high probability. So it's sometimes better to give the chart a little bit of time. On the low time frame, expanding diagonal over here, but also locally to the downside, an expanding diagonal, which is also of course not really that great. So yeah, at the moment I prefer to look more towards the lower time frames and really observe what is going on here to then give me probabilities for up or downside. I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.